Hello, everyone. My name's Cameron Kirko, and I'm the CIO here at Pitcher Partners Private Wealth. What I wanted to talk to you about today is really give a short update on the conflict with Iran and discuss and delve into some of the economic and investment implications. So, just to begin with, by way of preamble, wanted to touch on this is for informational purposes only. It doesn't consider your financial circumstances. So if you have any questions, please reach out to your advisor. Looking at the conflict, what we're noting here, it is quite atypical. We're almost 2 weeks in now since the US and Israel launched their air campaign, which has destroyed considerable military infrastructure, as well as claiming the life of Iranian's Supreme Leader Ali Khamenei, now succeeded by his son. But what has really transformed this conflict as opposed to previous ones in the Middle East has been just the widespread nature of it, with Iran looking to deploy its missiles and drones across the broader Middle East. And more importantly, the big issue here has been using these weapons to effectively close the Strait of Hormuz, which is a really critical waterway through which a sizable portion of global oil supply, as much as 20%, passes through in a given year, as well as being quite a key waterway for the passage of things such as fertilizers, aluminium, iron ore pellets. And we've started to see some real commodity price spikes echo in markets. And the real concern here is the negative consequences this is going to have for the global economy. So for richer countries such as Australia, for instance, look, we're starting to feel the impact on the Bowser. And you can see that where this chart just shows the average fuel price versus Brent crude oil. And we've seen quite a dramatic spike, and that's only going to climb higher once we update for the next week. But the big questions are really going to be, in terms of this broad impact, are twofold. So how long are these higher prices going to last, not just in terms of petrol, but across other commodities? And then secondly, how much are other parts of the economy going to suffer as we see spending diverted to energy costs? And you've already seen some cases, particularly in countries that are vastly reliant on oil imports. You've already seen, particularly in Southeast Asia, you've started to see rationing already being imposed now. And just earlier today, we had China announce that it's effectively halting exports of jet fuel, with the focus being on domestic consumption. And that's going to have a broad-based flow-on impact, as an example. So, in looking at the Australian context, one of the real concerns here is, are rate hikes now on the table? And it's not just in Australia, but internationally as well. We've started to see central banks increasingly warn about worries about inflation expectations rising in the wake of this conflict. And if we look at the RBA's decision, it's really two dimensions. So on the one hand, they could take the view that we're going to look through this conflict. We think it should be short-term in nature, which, going by history in recent decades, they tend to be, because the costs of prolonging the conflict are too high for all parties. So that's one perspective. The other contention, though, will be that high oil prices could entrench inflation expectations amongst businesses and households and lead to inflation becoming inflationary pressures staying at a prolonged higher level that the RBA itself would feel obligated to correct. Now, that's not a perfect logical flow necessarily. Like, what we're dealing with here is a supply shock, not a case of elevated demand, which rates would help correct. Like, the RBA could tomorrow raise interest rates, another 25 basis points or even higher, and that's not going to actually impact oil prices directly. It's going to have a slowing effect on other parts of the economy, but the use of interest rates as a mechanism doesn't actually fix the supply imbalance we're seeing with oil. So that being said, we have seen market pricing move materially. So what that chart there is showing you expectations for rate hikes as of 27th February in the light teal, and then in the darker green where they're currently looking at as of the other day. And as you can see, March is now being viewed as very much a live meeting, and these calls have only ramped up in recent days with the majority of Big Four bank economists now expecting a hike next week. So given this risk, there is a material prospect of at least one rate hike at the RBA's meeting over 16 to 17 March. If we turn next to look at equities, there the sector reaction has been largely negative over the course of this month, and it's driven the overall market down approximately 5%. So energy stocks, unsurprisingly, higher oil prices translates into higher earnings. So these have been the top performer. One area of weakness that might have surprised people has been in the mining sector, and that's really twofold. So on the one hand, higher energy costs slows economic growth, which is bad for demand across the commodity complex. The other factor is it also drives operating costs higher, with major miners very reliant on diesel fuel, which has seen prices raise as well. And so that leads to profit margins compressing for these companies. What we would say so far, this sell-off hasn't really priced in a prolonged disruption in our view. We've seen a slight correction and some pretty volatile days, but we haven't seen material correction in equity markets that's priced in sort of the straits being closed for a prolonged period as of yet. And so what we would expect for equity markets, while we continue to see sort of news flow, it's going to be a much more volatile period across the board. We've seen that in oil prices in terms of moving $10 or more a barrel in one day, and we would expect that situation to persist. We've seen reports, for example, overnight that Iranian forces have started to mine the straits, which would raise the probability of it being a prolonged period of shortages, because the mines would have to first be cleared before safe passage can be conducted. But as of yet, we're not seeing that reflected in market prices. There have been sell-offs in some sectors, commercial real estate, for example, but as of yet, it's been, I would say, despite the headline volatility, more of a sort of slight correction more than anything else. And what I wanted to close with was just saying, look, this conflict's had a global impact, and we've seen it really be felt in equities that have reliance on oil imports. But in other asset classes, the sell-off has been more orderly, and we have seen other asset classes really benefit portfolios. For example, those that have floating rate exposure are going to benefit during this period. What we would say with the conflict as of yet is an actual conclusion remains elusive, though we know de-escalation, in our view, is still a real possibility if the political pain becomes too much for the US in particular. We think it's very viable at the current circumstances to see sort of some attempt at a mission accomplished announcement, particularly if the pain at home is felt to be too much for the Trump administration. But lastly, and the important thing to note here, is your portfolios are well diversified across a range of different investment types for a range of scenarios. When we look to craft these, we're trying to consider different possibilities in which certain assets have the potential to outperform or to hold up and defend the portfolio adequately. So, for example, as I mentioned, in the case of inflation spikes, we typically see rate hikes, and that's where floating rate debt will benefit. if we do see a more prolonged period of the straits being closed and growth taking a hit, that's going to be a net positive for any bond holdings you might have, and you should see a capital gain as a result. And lastly, defensive exposures are a stalwart of our equity portfolios, and we've seen that in the likes of Telstra, the likes of Costco, National Grid internationally, and these holdings have held up quite well during the market volatility and would expect them to continue to play that defensive role. So if you have any further questions or concerns, we encourage you to reach out to your advisors for further discussion. And the important thing is we're always here to help and to support. Thank you.